And welcome, folks, to our latest podcast. I'm your host, Kong, and that's not. Oh wait, because I'm on the wrong window here. Yeah. So let me start off with the standard warning here. We may or may not have ownership or other positions in the stock mentioned on this show. Don't buy stocks based solely off of what you hear from this podcast. Always do your homework and research before buying, investing in stocks. And also, we are not your fiduciaries. And just while we're at it, we're also not really trained in this, but we are amateur investors. So, just to let you know, I'm your host, Kong, and I'm here with my co-host, Gibson. Oh, hey, well,
Nice to be
yeah,
here.
on to our first topic.
All right, let's do this. First topic. What we got?
Okay, so, how to catch a spoofer. So, there's a group called HTG Capital. They might have been victims of manipulation on the US Treasury futures market, specifically the 10-year Treasury bond trading on CME Group's Chicago Board of Trade. So spoofing is where a trader enters deceptive orders to drive up or down prices. Computerized trading makes this ever more present. The difference between standard buy low and sell high tactics is in the first phase is they put in shadow orders. People expect to drop soon and sell in anticipation. Then they buy back the shares at a lower cost. Then the second phase is they cancel all the fake orders to sell. And then in the third phase, which is a little bit harder to prove, is when they come in with a huge order to buy, and people think they sold too low, so they buy back at a slightly higher price, which is when they sell. And nothing's been ruled upon yet, but it should be soon. So.
Yeah, it's a very interesting tactic there. It's basically they pretend like they're gonna buy something, and then right before they're about to make the purchase, and right before it gets confirmed, they cancel it. The rest of the market reacts to that action as if they're gonna buy something. So everyone's like, "Oh man, it's gonna skyrocket." There's a huge order. Everyone buy in, buy in, buy in, and then basically they cancel, and everyone else it gets stuck with the bill.
Yep.
So it's a very interesting tactic, and it requires a lot of computerized sophistication to actually execute the strategy.
Yeah, that and also they're relying on computer algorithms to make their automatic moves, and then they come in and basically just go counter to that. So it's pretty interesting. So on to our next topic, which is wrong window again. Yes, next topic.
Fantastic. Eyeballs.
Yeah, Janet Yellen and the Federal Reserves may raise rates depending on the economic data or the outlook, is what Bloomberg is arguing. Traditionally, employment rates rising was a good enough reason, but the markets and economic activities of other countries, i.e. China devaluing its currency, thus causing other countries to do the same, has all of them worried. If rates rise during this period, it could send the markets lower. Consumer spending was also shown to be on the rise as well, despite Wall Street's concerns. The data says inflation is going to be on the rise, but then the outlook on Wall Street and lowered manufacturing are signs of a weaker economy. The Feds are about to meet in September 16th through the 17th.
Yeah, I'm a little skeptical that the Feds will raise the rates. If you were to ask me maybe a month ago, 2 months, 3 months, 4 months ago, I'd be like, yeah, we're definitely on track. But given all the new recent information and new introductions and new movements in markets, I think the Feds have to definitely give it some serious consideration before they increase the rates. And given the fragile state of things, they might just hold off. There's if you think back to when the Eurozone crisis with Greece and how the IMF was basically telling the United States Fed to hold off on increasing their rates, their primary argument was that, given the fragile state of things, what's the worst case scenario here? If you increase the rates before the opportune time, then you might derail the economy to a certain extent. That's what they're arguing. And they're saying that, well, if you wait a bit, and let's say you waited until the least, like not as optimal time to increase it, but is a definite sure bet time to increase it, then basically you can satisfy your need to keep unemployment low and GDP high without create like basically the Feds are trying to prevent a excessive expansion or overgrowth, because generally if you have too much of an expansion, there's going to be a giant drop, and a lot of times these are kind of associated with bubbles. The Feds are trying to prevent a bubble. So given the state of things and given the IMF argument and given the new information, I do believe that the Feds will probably have to give it some very serious thought, and it's definitely not as clear cut of a raise as it was back a few months ago.
Okay, then on to our next topic, and that is, so if you notice I don't know how smooth the animation is here, but basically a lot of investors are fleeing Japan's stock market. A gauge in the world economy is Japan, and it's plunging very quickly. Foreign investors are dumping Japanese stocks at a record pace. This hasn't happened at this rate since about 2004, according to Bloomberg. This is because Japan's major exposure to the Chinese, where most Japanese manufacturing companies have their factories based there. Of course, despite this guy right here, who goes by the moniker CIS, supposedly he made $34 million during the 1 week drop in August. So what's your take on that?
I'm jelly, dude. Jelly. How did he make 134 million?
No, not 134 million. Please, just 34 million.
Just 34 million. How did he make 34 million?
Basically betting against the market.
Yeah. Well, how much capital did he start with? Did he do did he do options, or did he do stocks, ETFs, or did he
combination of options and ETFs?
I see.
Yeah. So that's all you got? Well, I mean, if you want to learn more from him, though, you can follow his Twitter account. So you can catch that at the website, Bloomberg's website, that is.
Yeah, there's not much more I can say besides jelly, dude. Wish I did that.
All right, then, moving on. Now, let's see. The worry over China's moves to try to prop up its stock markets and devalue its currency to increase exports have caused a domino effect amongst other nations who are afraid their competitiveness about their export competitiveness. So they're all doing the same. According to an opinion piece that appeared on the Wall Street Journal and the Brookings Institute, the Chinese yuan won't increase further from the U.S. before the two presidents, that is Obama and President Xi, will meet later this month. But after the meeting, no one really knows. What do you think?
Well, I think it's a basic tragedy to commons, like game theory. China will keep doing what's in its own best interest. The West will do what's in its own best interest. And it's very unfortunate that China manipulated their currency in this manner, just because I believe a lot of the reaction in the world is that they thought China is going to let market forces dictate the currency value, which basically will reduce the amount of export China has and greatly increase the imports. Now that's a boon for the rest of the world. The rest of the world, the reason why is just China's been exporting so much and they were so cheap for such a long time that a lot of the other countries' GDP has been kind of depressed. And I think a lot of countries were looking forward to China to just start buying things and just reducing that trade deficit between their country and China. And this move here is basically forcing the competition to move away from the market-based competitions and more like governmental-based actions on how they, compete.
Well, I mean, some people are debating and saying that some government intervention is needed, and when the government did decide to speak with the major fund managers in the country, they did manage to bring a slight bit of stability to it, but I mean, of course, it still dropped, and the Chinese are wondering why. So then their next best move was to devalue its currency. So, I mean, but of course, like we said earlier, that created the domino effect. So, is it really a matter of China messing with the economy? Because I mean, let's face it. Even the U.S. we have certain policies that there are moments like in 20 you know 2009 when everything hit just completely dropped and tanked. We came in and we bailed out the bankers, right? So we did that. Now, so it's not as direct as what the Chinese have done, but there still is some market intervention. So, I mean, when you're talking about market intervention, that shouldn't be the only criticism. I mean, what specifically are the Chinese doing wrong?
Well, well, I think it's just the way the world views the intervention, and as opposed to, I think everything is questionable, but whatever the sentiment is that I think there's just a giant concern that maybe the world's growth, global demand is slowing, and basically the issue with China and what they're doing to devalue the currency might be a sign that global demand is slowing. And basically, if it's slowing, if it stops growing, then what's the next step? It's probably shrink. So that's like that, the fear and the possibility of that, that's what's gripping the market right now. And a lot of super wealthy investors that are in the market, they really have no incentive to stay in the market. I mean, if they gain another 10%, not be meaningful to them, but then they can lose a lot. They stand to lose a lot if the market starts dipping. If you take a look at if you just take a look at the Dow, take a look at S&P 500, and you look at all those dips, for them, they're thinking, hey, is this the height of that curve? Is it about to dip down? And if it dips down, I could lose my gains for such a long period of time. And for them, they're like, you know what? We already made enough gains. We could just pull out the market. And I think a lot of the shrinking movement is a sign of that. I have a theory that the drop towards Friday's weekend is just the 3-day weekend. They're like 3 days, a lot of time for news. For all we know, China can change a whole mess of stuff. So we are basically gonna sell, no matter what the economy is, no matter what the report earnings is. There's no point in holding our money in the market. And I think main reason why these actions are likely to happen is just because we are in such a volatile time. There's no doubt that the market's been extremely volatile, and for them, even Bank of America is telling their brokers to pull money out of hedge funds. They're too big to move quickly, and that's a signal to us that they think they also believe that we're in volatile times. So in volatile times, people just sell their stuff before the close of the day. They sell their stuff before the end of the week because they have really no incentive. And there's a lot more volatility throughout the day because they're going to do a lot more buying and selling just because they don't know which direction things are going to be. They don't know if it's going to open up, if it's going to go open down, if throughout the day it's going to sink a lot, it'll rise a lot. For them, they're like, you know what, this volatility, this is no longer investing. This is gambling. And for them, they're like, all right, time to pull out the market. And I think that's contributing a lot to the why the market's shrinking a little bit or being depressed right now.
Actually, there is one thing I forgot to mention. So for those of you who don't know, September 3rd was China's celebration of their victory over Japan, and to not mess things up, they did a lot of things like took a lot of restrictive measures all throughout the city. They even told factories in surrounding areas to stop production, which is, of course, going to hurt their economy. On top of that, for the rest of the week, they said all markets will close. So it'd be very interesting to see how the market's going to reopen on Monday. So that's going to be, yeah.
Yeah, that's gonna be very interesting. I mean, you have to realize that we are a globalized, like the stock markets now is completely globalized. Our businesses are now completely globalized. You buy a $5 burger here in the United States, you go to China, you do the currency conversion, it's still a $5 burger over there. It's quite shocking. But yeah, the stock market is the market, so it's a factor of supply and demand. So now we just basically isolated a whole group of buyers out of the market, a whole group of sellers. I do wonder, like what's going to happen on Monday. Perhaps due to lack of players, it's just going to be very calm and very flat. Or, people are desperate to sell their stuff and there's no buyers, so it'll drop. Or there's a lack of sellers and it'll go up. But no one knows at this point. Is it gonna rise or fall?
Yeah, you're right. Really, no one really knows, which is, once again, it's fun times, fun
Yeah,
times.
see, like it's a little bit different. I think there's a giant contrast between what America did and what China did, because America bailed out the banks. So basically, the government was declaring at that point that these stocks are now at their lows. We will prop them up. This is the floor. Buy in right now. And like in that time, a ton of people made a ton of money. The reason why, because they're like, hey, the floor has been signaled. You buy and hold at this price, you're gonna make a ton of money when it rises back up to the top. But China, in this scenario, there isn't really that form of signal. There really isn't that form of commitment, and there's really no need for that level of commitment. Because you think about Bernanke and what he did with the banks. Did the Fed chair, have a choice in that matter? And the answer is no. The reason why is that economists have two tools to regulate their economy. They have monetary policy and they have fiscal policy. Monetary policy is adjusting the interest rates, the money supply, through various means, so that there's more spending activity going on in the market. And then fiscal policy is increasing government spending, investment in infrastructure, schools, and so on to stimulate the economy through another means. And monetary policy is much more effective. I believe the metric is 10 to 1 to like basically the effect on money supply and spending in the economy as opposed to fiscal policy. So for Bernanke, and a very necessary component of monetary policy is banks, because what the Feds can do is they change the interest rates, but if the banks aren't there to help redistribute the money after the interest rates are changed, then it's completely meaningless.
Yeah,
So
yeah.
yeah.
And then with China, I think one of the commentaries, Mr. Stephen Hsu from Hong Kong, he said that it was more like what's his name? Li Keqiang, Li Yakern. He basically had a lot of deals. Him and his friends and his cohorts had a lot of deals with a lot of the companies that were going on their initial IPO that week that the market had dropped. And he said, dang it, I'm not going to let this happen, because basically these guys had already bribed him or his, friends or whatever. And of course, if these companies go at a time when the stock market is dropping, that means these companies' values are also going to drop as well. So, you got to, they scratch your back, you got to scratch theirs, kind of the thing. That's some speculation, but hey, just throwing it out there. Now, one thing I wanted to comment on was, which is really funny, is how when 2008 happened, because we were all worried about like a lot of the Chinese debt that we had, and the Chinese were worried about the debt that they had bought from the U.S. They kept on making a bunch of these ridiculous remarks, like things like, "Oh, the U.S. is being irresponsible with our money," blah blah blah. Whatever. I mean, like, look at what they're doing right now. Their policies aren't really doing a whole lot. At least with America, things have worked out. But as far as whether or not it's going to work out in China, that, once again, that is a question. But going back to another article that I had found, it was just released, I think, today. Let me go back and switch screens here. So a lot of the criticisms that we have with China right now is we keep on thinking that it's going to go into this economic downturn like Japan did during the 1980s. But these two people, Enda Kurin and Yoshiaki Nohara, they argue that we should actually be looking at China, and that this is just might be a temporary slump like Japan's 1960s, which actually led to an economic flourishing, or whatever the term is.
I think, no matter what the news is, there has to be optimists and that there has to be pessimists. It's yeah, it's just the question is very simple. Why would the stocks go up? Like there is no very clear indicator of why it would expand. Did we unleash new technology? Is there some innovative thing? Is this a golden age of expansion? There's really no clear signal of that. Back like a couple of decades ago, we had like Intel, we had the internet, we had like we pioneered a lot of the internet technology, had a lot of PC expansion, then we have a lot of smartphones going out. Like at this period in time, there's really like nothing that says, hey, you know what, invest. Oh, well, of course, there's the housing bubble which burst, But at the same time, because it burst, it was at the bottom. There's a lot of people throwing the money in, right? And I think a lot of actions we took, from an economic standpoint, was great for recovering from it. But at this point, like the Feds are increasing rates because they want to slow down growth. There's issues with China, and they have expressed that they don't want to import as much, which both also says, hey, growth might stop. Growth in the sense of money coming into the United States, or basically money in the economy at play, and so on. So a lot of these signals are probably what's causing a lot of people, hey, you know what? Maybe it's time to let go of our stocks and hold on to cash or get something more stable, or etc. There's a lot of questions, and I think a lot of uncertainty, and because of these lack of clear signals, people are like, we don't know if it's going to grow up, but we've seen it dip down. So they're like, maybe it's time to just pull the hell on out, cut our winnings. A lot of people have made a ton of money if they've been investing over the past few years. You look at the Dow, pretty much every single stock has gone up, and every single stock has recovered. But yeah, they're like, you know what? Maybe it's not worth holding on to.
Yeah, all I can say is I came in early enough not early, but enough that I'm still above water so far. So.
Yeah, I have to keep thinking about that, as I basically am right where I started initially before I start managing my money, which is very unfortunate. Made a few mistakes during my learning process on stocks and so on.
That's all right, because when I started out, the market had dropped back down, and I think I was like short at one point, maybe $3,000, man.
Oh man, dude, it's just horrendous. I think it's more of not so much a money thing. It's more of a judgment call and a pride thing. Because at the end of the day, all you can really do is, buy what you believe in and what you think would do well. And it's, like I do believe in fan investing. If you're a big fan of a certain product and you just believe in the company and what they're going to do with it, then it might be a sure bet to go with it. Just because you're going to keep buying that product, you think everyone else can keep buying the product, and you're going to keep actively promoting that product. There's a cult following. It's for a little bit. At least it will hold its own water. It will hold on to its value for a little bit. I mean, not many people will attack it. Like for me, it's like, if someone just said, hey, you know what, Google stock's going to drop through the roof, I'm like, really? Google, of all stocks? Google with its giant empire and the billions and like $60 billion.
To counter you on that, first of all, they actually said the same thing about Lehman Brothers. It was so big, and everyone thought, well, you bailed out the other banks, why not Lehman Brothers? Well, the government went ahead and just let them go under. And then to the other point, actually, now I lost my train of thought. Never mind. Forget the other point.
Yeah, but that's the thing, is that, when we assess like things are going under, right? Lehman Brothers, they had a lot of toxic mortgages. There was like derivative loans and mortgages and all these other things that were happening with it. But what can possibly happen to Google, right?
True.
What major event can cause Google to basically go under and go out of business? That is a huge question for me, and I just cannot find the answer. And because I can't, there's the pros and the cons, or what could make it go up and what could make it go down. You have both sides of this, and I can only, I always say that perhaps there's nothing on the upside, because I'm like, they're already at the top. I can see that they will flatline. I don't really see that they'll have a new product going on. Although, that being said, they do try to venture in new spaces all the time. The Google Voice, the Android phones, they are constantly venturing everywhere. Google Wallet versus Visa, and so on. There's a ton of ventures, but really the question is is there anything, one core thing that would bring Google down? It's anything short of the United States government saying Google has infringed everyone's privacy and they're just killing search engines altogether. I do not see the stock or the company going away.
Hey man, you never know. What if a giant electromagnetic pulse just hit the earth, and all of a sudden, your
sell your stocks.
No more internet.
Sell it.
Yeah.
Get that cash.
Buy gold. Make sure you buy gold, because, if something like that happens, gold is, going to save you.
Well, at that point, what's the panic buy? Why people buy gold, right? They're thinking, something that really holds on to its value real well, something physical you can have, and so on. That's really what it is.
It
I don't
doesn't matter if
know.
it's gold or what, man. You're going to be using the barter system at that point. I mean, really.
Exactly. That's what it is. That's pretty much what it comes down to, the barter system. And that's some scary space to be in where you have to resort to bartering.
Yeah, all right. Well, let's not think about that. That's just really depressive. All right, on to the next topic.
All right.
So back to Bank of America, Merrill Lynch, what you were talking about earlier. They did come out with some predictions, and they said that there's a disconnect between stocks and bonds, which may mean more chance for stocks to drop. So Gibson, can you explain why this is? The article goes on into equities and bond prices. So how exactly can a disparity lead to such a drop?
Was this article saying that bonds would drop or stocks would drop?
Stocks will drop.
Well, I'm not too sure why they would say the stocks would drop, but the value of bonds could drop in a rising market. And basically, a bond guarantees a certain interest rate, a certain payout. So if the market is picking up, then the bonds will drop in value, just because the bonds might pay out at like let's say 4% or something, but then the stock markets are paying out 10%. Then people would want to buy stocks instead of bonds, which drives the price of bonds down until some sort of new equilibrium is reached, where it's, like attractive again. Now, conversely, I assume that if the stocks are going down in value, then the bonds value go up. So I guess it's also implied that if the bond values go up, then the stocks would go down. But I feel like, bonds is a bond. There's really nothing moving it at all. It's a contractual agreement for you to get a certain payout at a maturity date or a certain pay.
Well, I mean,
period.
but before you go on, so I mean, even though they were talking about bonds and stocks specifically, they were also talking about like debt and equity as well, and there's more concentrating on the debt equity area of both bonds and stocks.
So what was their argument that the stocks will go down, or I guess it's the bonds? Is it? I guess is it? All right. I guess one thing that can be an indicator is that in volatile times and people are fairly feeling uncertain of things, for them, they'd rather hold on to like a 2% gain that's a sure bet, as opposed to the stocks that they don't know is going to go up or down. So the fact that there's more interest in bonds would indicate that the stock market is more volatile, and because it's more volatile, it might go down. A very simplistic formula is called expected value formula, and the expected value is equal to the value times the basically risk involved. And the higher the risk, the more volatile it is, the lower the expected value. So if you have a computerized algorithm and there's a lot of like movement in the market, the expected value would just go down naturally. And if the markets or the algorithm is the market is truly algorithmically traded, then they might stand a reason that they're thinking, the prices are dropping and sell.
Okay then. So let's see. Okay, so next topic. Netflix. You have a Netflix account, don't you?
I do. I love Netflix. And yeah, I don't know what to say about this company.
Yeah, well, it's lost 13% from its highs in August because it's been trying to carve out a niche by only showing original content and not showing content which can be viewed elsewhere. This also eases them from making complicated deals with bigger studios, but may drive away numbers, or the numbers of customers, that is. Hulu is taking on these non-exclusive contract deals Netflix is refusing to renew. However, when it comes to original content, they're facing competition with Amazon's original content, and speculation with Apple's upgrades in their Apple TV lineup may shake things up as well.
It's a good time to be an actor. Bad time for an investor.
Yeah.
Bad time. Because, there is no clear winner in this market. And when there's a lack of clear winner, there is a lack of certainty. Lack of certainty, just the lack of just giant migrations of money, just a lack of inflow. into any one of these. Like for example, instead of a 100% buy into Netflix, now you have a spread across Amazon, Apple, Netflix, and Hulu. That's a 25%, allocation. That's a 25% movement in either cases. And because of all these options, people are like, you know what, so that's a sure bet. In fact, if Netflix was a monopoly in this space, it's an extremely clear bet, and just no questions. Everyone who's taking a course in economics know that if you are a monopoly in this space, you will have profit maximization. There's no question about that. I
Yeah, I
personally
think
do like
I think
Netflix.
that is exactly what they're trying to go for again. I mean, because they had that domination with the mail-in DVD orders. Of course, now as they predicted, DVDs are going away, and that's why they went to streaming video. And of course, there was a lot of hoopla about that whole thing and changing the pricing plan and all that. And now they're going with original content. Sure, granted, they don't have as much of a monopoly as they used to in their business arena, but I think they're at least trying to get there. But you're right. With Amazon, I think the Amazon has a lot of capital, and they can churn out their own original content as well. I think that's why you saw a lot of not necessarily them producing their own unique TV series yet, but they have been buying TV series, foreign TV series specifically, that you can't find in the U.S. And they started out with that. And I think eventually, when they get enough money, they probably will go for funding original productions.
Well, what you have here right now it's an economic model known as an oligopoly. So oligopolies are basically monopolies or monopolistic competition. So oligopolies are basically just monopolies trying to differentiate themselves so that they're not competing in the exact same space. So you can see that the actions that Amazon's doing, the actions that Netflix doing, and Hulu, they're trying to avoid the same space so that they have basically a monopoly in their own market if possible.
Right.
Although I do want to say that I wish Redbox would step up their game a bit. I do like the fact that they still believe in physical DVDs, although I haven't really used a DVD in quite some time. But I like the concept.
That's exactly why. People like you who believe in them, I mean, you're not even using the services.
I like I think it's a bit of a nostalgia, like I miss the blockbusters, I miss the Hollywood video, I miss the actual physical presentation of the disc, and I think Redbox has done a great deal in the sense of cutting the cost down and still making DVD accessible, but Netflix has the mail thing locked down. Of course, the Redbox stepped up the game and also offered that service, and they also offered streaming video content. I think we'll have a very serious competitor to Netflix.
Hey, you know what though? I mean, yeah, okay, nostalgia is a thing, but nostalgia is not going to save you money now.
Yeah, I think so. It probably would. I think another thing is that sometimes with the DVDs, as soon as the movie is announced and release date is announced, they're on the shelf. And with Netflix and whatnot, I guess they are slightly behind. They have to negotiate with the content company. But with the DVDs, it's closer to the original models or the old-fashioned models of like content release and etc. So I think that gives Redbox a slight advantage on that front. That gives DVDs a slight advantage on that. Although with the movements they had in their leadership over the past year, there is some question whether or not, like which direction they're going to go. But it's kind of, it goes out saying, I think the major players in this market is Netflix, Hulu, Amazon, maybe possibly Apple coming into play. Redbox is definitely still a contender. I think if we keep an eye out on how the movie moves, we can definitely figure out where the market's going to go on that front.
Yeah, well,
Well, I think in this case, it's a very interesting closed system. Is that the product is watching stuff like media. It's like basically media, movies, etc. And then we have a lot of companies that are competing in the exact same space. My theory is the better one company does, the worse another company would do. So if you can create a map of who's competing against who in what space, and there is a lot of people don't understand that money is finite. Spending is finite. Disposable income is finite. Money spent you know, although there's a form of direct competition, which is these companies are competing against each other directly, and there's a form of indirect competition. So $3,000 spent on a car is $3,000 you can't spend watching movies, and that disposable income is generally finite.
Yeah.
So I think, like I think the very clear like competitors are like Amazon, Hulu, and so on and so on. But I think the question is, what's the effect it's going to have on cable companies? What's the effect it's going to have on movie theaters and etc.? I'm very curious about that.
Yeah, but that's a longer battle to worry about. I think right
Oh,
now.
for sure, for
Yeah,
sure.
yeah, yeah. But anyways, so yeah, let's move on then.
All right, next topic.
Right here, Square's IPO. I mean,
Oh,
it hasn't happened yet,
right.
but back in June, Square, the payment platform, filed for an initial public offering or IPO, which means if approved, you can own some of their stocks. So
Awesome.
Investopedia looked at just what their business is and how they're making money. First and foremost, they enable payment processing, so their competition is naturally butting up against traditional payment platforms like Visa, Mastercard, and American Express. And because they were able to break into that market with their device that simply attaches to your smartphone to accept credit card payments, it's also gotten the ire of PayPal. Not only that, however, they've expanded into offering small businesses financing, which means they're pitting themselves up against banks offering business loans and also offering payroll services, which means companies like automatic data processing and paychecks will see them as a threat as well.
Yeah, it's amazing.
It is.
I
And the
don't have
future
high
is
hopes
here.
for Square. If you were to tell me that IPO, I'm like, I don't know about that. And the question is, what is your moat? What's going to prevent Visa, Google, Amazon, and etc. from creating a product that's just like yours, and then cutting Square off from the system? They're like, you know what? We do not want you to use your own. You have to use your own payment processing. Behind every single type of credit card, every single type of transaction system, there's something called a payment processor, a payment gateway. And for them, I feel like they might have enough pull and sway that they can easily, decimate Square once it becomes a major competitor to them.
I don't know, because then I mean, uh, under that sort of logic, then things like Google Wallet, Apple Pay, these things wouldn't even exist at all.
There's a lot. Well, a certain logic is that when you have like just regular business. So basically, like let's say I'm in business to make money, and if I'm starting to lose money due to competition, I'll close down, etc. But there are exceptions. Like for example, Google Wave. This product never took off, and there's many Google products that never ever take off, and they are not a success, and they just bleed money all the time. But the company just keeps throwing money at it. So I feel like in this space is very likely and very possible that there's a lot of major companies that are currently succeeding and they would not mind to have a division that directly competes against the concept of Square and have it bleed money. And at the same time, you have to think about what is Square. It's simply a miniature device. I mean, if it went from nothing to something right now and it was revenue positive, then what's to stop Google, Amazon, which has even more resources than Square, from doing likewise?
No, but that's the thing. I think they are revenue positive right now. I mean, it's pretty amazing actually. I mean, like so even though yes, you're right. The thing they have going for them is that they have that little device, but then of course PayPal also came out with the same thing, but that was only in response to them. Now, whether or not PayPal's device is actually doing any better, I'm not sure. I think the payment terms between both companies' devices was pretty much about the same. But I think the way Square has been going about, I think they do have an advantage with small businesses right now. Let's say if you don't even have a storefront, you could just be hawking your own little things, right? Like selling it off, at some like the boardwalk or something like that. You just
Hmm.
roll out a blanket, put your little trinkets out on there, and then bam, people are like, "Well, I don't have any cash with me," and then you're like, "Hey, it's all right. I take card." Bam.
Exactly.
And you see a lot of Square devices, more so than PayPal even.
Yeah, well, I think the reason why it's allowed to, basically, these guys just allow Square to exist because they're like, you know what, this is not a threat to us, because for them, they could squash Square, and that's why it's kind of like have the chip lead. You know, some guy's absorbing. You're playing poker. You have a tenfold chip lead on top of everyone else. These people are duking up amongst themselves. You do not feel a need for you to actually contend with them at that moment. They're not exactly a threat to you, and I think that's
No,
what's
no, no,
happening.
no, no, you're wrong. You're wrong. Actually, a lot of people saw this as a really good thing, and they wanted to buy Square, but Square didn't want to be bought out by anyone else. So they were well aware of this, the situation. They know that Square is very much a threat.
What's the Square threat to?
The, I mean, I guess well, at this point mainly PayPal, but possibly in the future, other traditional payment methods as well. Like I said, Visa and all
Well,
them.
I don't say it's a threat to PayPal, and the reason why I'm saying this is because Square which company was in the market first, and I'm pretty sure Square was in the market before PayPal, unless I have it wrong. And
No,
if that's
you're right. You're right. I guess PayPal has always had an issue of trying to strike within the physical world because they started out as purely an online thing.
hmm
And when they saw Square, they wanted to buy them out but couldn't. So I
I
guess
wouldn't say they decide not to couldn't buy them out because I believe PayPal just said, you know what, we'll just start building a Square. Like there's no reason why we need to spend like $20 billion or whatever on Square when we could build it for like 100 million or less. You know, I think that's a lot of the thought process behind it. And even Google, let's say whenever there's a profit, there are companies that will emulate. You know, Visa, there's Mastercard, there's this Mastercard, there's Discovery, and so on. There's Facebook. Google have Google Hangouts. You know, let's go Facebook is a little bit too mature. But back in the days, there's like networking things like Friendster, Zanga, and then there was like Facebook, and now there's Google Hangouts.
yeah.
I'm trying to illustrate the fact that when there is profit and when there's success, competitors will come into the market. And at this point, I don't think any competitor has thought it was worth doing, but I feel like it's possible, and which is why, and the possible competitors, the possible contenders against Square would probably be Google with the Google wallets, Amazon with Amazon Pay, Apple Pay. There's going to be PayPal with their own service. Visa might come in, you know. So all these contenders versus Square, and I'm thinking if I had to bet my money, I would bet not Square.
Yeah, I don't know. Actually, another thing I just thought about was Walmart. Let's not forget that they also have their own money wiring service as well, which is kind of interesting. So even someone like Walmart is trying to get in on the money wiring, money transfer, financial business.
Yeah, because Visa has always made so much money. You know, Visa basically has no competition right out there. They're so retardedly successful. Yeah, all these companies, what are they truly trying to emulate? Whose money are they truly going after? They're trying to go after like the credit card payment processing companies. For why? Because like every single transaction, no matter what it is, you get a few percent. That's amazing. Like every single transaction out there, you get a few percent on. Like a percent on the transaction fee, 2.5% on like buying and selling things. To you, 2.5% might not be in a lot, but $100, that's 2.5 bucks, and that's just providing the infrastructure for you to make that transaction in the first place. And the sheer amount of transaction that goes on every single day with that merchant, every single day within that region, that United States, and so on, that is an insane amount of money. It's extremely lucrative space.
Yeah, but I think that's the appealing thing with where Square has gotten themselves positioned right now, because they're not only just providing that platform to process the payments, but they're also helping small businesses that already use their products, most likely, and on top of that, providing them with a payroll service as well. I mean, that also butts up against with Intuit as well. I can't remember what their stock symbol is right now.
I think Square, like if I were to look at Square, I think it's a acquisition play. I don't think they're gonna be in the market for a super long haul, and I think they're just holding out in hopes, you know, post IPO to have another company like Google buy them out completely, or Visa buy them out completely. But at the same time, the question is, why buy when you can build? At this point, the cost of building probably is, buying an acquisition is so high, they are going to get a bidding war with all these other major companies that it almost makes more sense for them to just build it. Which is why I'm so skeptical with Square and their IPO.
So you're not going to buy their stock when they come out, huh?
I might consider shorting that stock, or I would look at it. Like I said, I formed my theory. I'm just not sure why it go up. And since I'm not sure why it go up, then I wouldn't want to go. Now the question is just my own judgment call, right? I'm basically analyzing the stock. I'm taking the things that will make it go up. I'm lining the things that will make it go up, the things that will keep it stable, the things that will go down, across three columns, and I have a rough gauge of the effect of these factors. And for me, I'm like, like Google, right? Who's going to compete against Google? How they can come in? Google has so much. There's things called barriers to entry. Every single successful company creates things called barriers to entry. Barriers to entry prevent other people from copying them. Facebook, where was their barrier to entry? I can tell you, I've watched Facebook go from Mark Zuckerberg's wet dream to what it is now. And I've been following that company, and I'm just thinking, what's this kid doing, with his very creepy stalker book? And now it's blossomed to what it is. And there's one point in Facebook that basically modified and changed it completely from every single other social network out there. And that point was when they offer photo albums. So the photo album is extremely costly. That just, like the server costs to hold all those files, or transfer all those files, etc. But it's a barrier to entry that basically says, hey, you don't have enough money to play this game, then you cannot keep up. It's kind of like a lawyer war, where basically he who has the bigger wallet is going to win this game. You're going to basically run out of funds to keep postponing, and we will eventually win. And that's what they did. Now with Square, who's the competitors? What's the barriers to entry? It seems very weak and lacking. So because of that, that's the reason why I caution against Square. Now, Square still could go up a lot. Why? It's because of acquisition play. There's firm belief that a certain company is interested in acquiring Square and its market share, then maybe. But if it's not, I wouldn't say it's an innovative technology. I don't think it's anything that they can patent. They're pretty vulnerable out there. So that's the reason why I have a hard time betting with Square. Like for example, why is Disney such a sure bet? Why is Coca-Cola such a sure bet? Why is McDonald's such a sure bet? Not so much sure bet, but why is it so stable? It's just the sheer amount of barriers to entry. Like for something to directly compete against McDonald's, they have to have an economy of scale going. Like McDonald's had the entire supply chain conquered and dominated. They have good values and cost savings all across the board. So they can offer prices much lower than any type of competitor. And that is their barrier to entry. That is their moat. That is what prevents people from muscling in on McDonald's. But for Square, I really can't name many things.
All right, I'll give you that. No, I'm not saying that I wouldn't buy into Square. I think if I have the money, I think I would. Despite your warnings, I think ultimately it is going to work out. I can't say concretely, aside from what I've said already. But you do have some valid points. That's all I'm saying.
I think devil's advocate contrasting point is fine to have. It's important to assess both sides of the argument, and in essence, it's basically just understand. Like the only thing you can really do is understand why, and hope to understand why, and that's roughly it. If you're gonna play in the market, that's the best result you can have, because you cannot predict the future. No one in the market knows it's gonna go up or down. But it's kind of like you vote with your money, and you stand behind what you believe in, and in a way, it's just kind of like basically people voting for what they believe in. A lot of people believe in oil. It's built the backbone of this country, so they're going to invest everything into oil. And then a lot of people believe in gold. They believe that it cannot lose value ever, which is a fallacy, but they do believe that, so they're going to throw everything into gold. Healthcare is also a very interesting one. Healthcare, because is now a government subsidized thing. Utilities also government subsidized. So a lot of these companies that are government subsidized, a lot of people do bet into it because they feel like it's a sure bet, and I do not blame them. I think that this is a very valid belief.
Yeah, it's valid to a certain point, but at the same time, because it is government subsidized, if the government decides to come out with some sort of regulation of some sort against that industry, then they're pretty much screwed as well. But
Well, at
anyways,
that point you sell, right?
yeah,
Like no matter what it is, like for example, if the if China declares World War III, or Germany declares World War, Russia declares World War III, everyone's going to liquidate their position in the market. There's just going to be a giant panic. Just new news, variable change. Whenever you have new additional information, that future that you've invested in and you believe and hope for might no longer be there. And because of that, it doesn't make any sense for you to be in the position you're holding now. So yeah, everything can change, but there's certain positions that are less likely. And if you ever work with the government, you have to go through hell and back to get anything done.
yeah. Well, I mean, of course, yeah, yeah. We're not going to get into my history. So, anyways,
My history.
yeah.
I've been trying to evict out a tenant forever. I've been trying to evict my roommate since last year, and I'm like, holy crap. Yeah.
Yeah, well, that should be a different topic for another day. Yeah, actually, let me
Completely.
know. Let me know when that actually happens, and then we can
Oh,
actually
I
talk
have the
about it.
date. I have the date.
Oh, when
So
is it?
yeah. I can't say. I have a
Oh,
letter that says I should not disclose or inform him, and he might be
ah,
following your podcast. They want it to be like an element of surprise, ninja him out.
right, right. Okay, okay. Well, let me know offline then. Let me know offline.
Oh yeah, for sure.
Okay, all right. So, anyways, so next topic. Let's see here. Yes, next topic. The
You
dangerous
labored hard
separation
today.
of American upper middle class.
Ooh.
Yeah. So one of the major market, or no, sorry, that's the next one. So one thing that hits to our heart is the very reason why we're getting into investing is that we don't want our savings to slip away, and we want to live a financially secure life. I think this Brookings article that examines the different stratas of the middle class earners, upper middle class, and lower middle class, it's really interesting. So around 88% of people think of themselves as middle class. So how do they come up with an objective view of this? Aside from taking polls and comparing income data, they looked at other factors like education, marriage, and other things that may affect where on the spectrum of middle income you fall under. I thought it was it was really good that even 4% of advanced degree earners, well, not necessarily good, but interesting that even 4% of advanced degree owners could even be at the lower middle income class. Despite this, however, generally an advanced degree means more earning power. They also note that upper middle class tended to vote a lot more than those in other stratas, and that much of the other things that they vote for, of course, are meant to protect their own interests, which actually may threaten those in the bottom rung of the ladder.
Yep. This is Game Theory 101, right? Everyone watches out for themselves. And because of that, there's something called a Cournot solution, which is what happens when everyone watches out for themselves or becomes very selfish and greedy and so on. Hopefully that's not the case for global warming because we are all in deep trouble if that's really the case. So yeah, like why would they vote for policy that benefits them? That's exactly the reason why. Is and not only that, but there's a lot of viewpoints. Like for example, a lot of Republicans or conservative voters and whatnot, they have the belief that just they've earned it. They worked hard and they spent their hours. They slept very little, and every single dollar they took advantage of all these opportunities. They paid attention. They studied hard and so on. They toiled, and then they got to where they are. Of course, on the flip side of other like this the spectrum, there's other people that basically they felt like they would want to, they can, they have, but they haven't been afforded the same opportunities as other people, and so on. So despite no matter how much harder they work, they just cannot break into the upper class. I
Yeah,
think
yeah,
it's
that's the other thing that they actually went into is that do you believe that hard work will actually pay off? And yeah, you're right. That's exactly what happened. The people in the upper strata thought, yeah, hard work does pay off, and then the people in the lower strata they thought that, well, they were less likely to think that. Now, what's interesting is when you get into, the psychology of these people, is that, people that are in the upper strata, did they really work hard compared to the guy that's barely making minimum wage, if he is actually making minimum wage? I mean, he's working his ass off, and here, this guy who's programming, not necessarily saying that programming is less of any work or is somehow less stressful, but in terms of just sheer hard labor, nowhere near as laborious as, say a construction worker or a coal mine worker, even.
Yeah, I think it's like definitely a difficult thing to assess. For example, sometimes I watch like the people who work like minimum wage labor and the cleaners and whatnot. They work minimum wage, and most likely it's their second or third job that they're working that day. And the sheer amount of hours they put in and how much stuff they go through and how busy they're toiling, as opposed to a person that might be just playing golf, right? He's golfing all day. Really, is that considered work? Well, you think about the upper spectrum of things. Major deals is built upon relationships. It's not so much the money anymore. To them, they already have all the money in the world. To them, they're like, you know what? I like this guy. I like working with him. I have fun with this guy. I'll give him my money. That's at that point, it's really like that. And at that point, what is work? How do you work? What is like? How do you bring home the money? How do you bring home the bacon? To you, I can toil like washing dishes and scrubbing cars and taking out the trash all day, or I could work on focusing on relationships and buttering like talking to people in country clubs and whatnot, and get the CEOs genuinely like me, appreciate me, and want to help me with my company and perhaps give me like a multi-million-dollar deal and etc. That time I spent mingling basically pays for any type of salary and company expenses and justifies my entire time much better than it would.
Right, but if the poor guy, was mingling with his friends, it doesn't necessarily give him the, same amount of, I don't know, business contracts.
Yes,
that
it's
this
just
guy we get.
it's like
He's a lazy guy. He's just
it's not the lazy. It's
out
just
with
how
friends.
the money is made. At different rungs of society, money, the way money is made is so different.
Yeah.
It's shocking.
All right. Well, so do you think we should end it here?
That's up to you. You're the host,
well,
and you have the topics.
Let's do that. Let's move on to recommendations.
Recommendations.
Yeah.
Is that our closing segment?
Yes.
All right.
So here's my recommendation, the VIX, since the media's been covering this a lot more lately. One of the major market indicators is the S&P 500, but recently more and more people have been talking about the VIX, or the S&P 500's volatility
index.
Yes.
Oh, yeah.
Which recently, it has been coming back up. However, if you notice a comparison between now and back in 2009, it isn't as volatile as compared to then. However, it's still volatile nonetheless. Now, as an investor, this is a good indicator to know when you should and shouldn't buy depending on what your strategy is, but use it as you may.
Yep.
So what about you? What are your recommendations?
Well, it's the volatile index, VIX, is clearly communicating what we've always been saying, is that this is a very volatile time. The market is going to swing up, swing down, etc. This is a time period that a lot of people can gamble money. They could possibly make a lot of money, they could possibly lose a lot of money, but this would be more of a time period that you're gambling more so than anything else. I would recommend, like in this time period, unless you really know what you're doing, I would kind of pull my money out. Yeah, I mean, look, let's say it's volatile, but why is it volatile? Because we're not sure if it's going to go up, we're not sure if it's going to go down. But once the volatility has passed and you're fairly certain which direction it's going to go, you can always reinvest that. Your money's not going to go anywhere. Sure, you might miss out on some gains, but more importantly, you can miss out on the losses. And if it's going to go down, it might go down a lot. So the question is whether or not you really want to be there for that drop. And in terms of the gain side, I'm not sure where the gain is going to come from. So because of that, my recommendation right now is basically stay out the market, hold on to your cash, buy some more stable, like like real world investments, maybe, maybe look into that condo, might be a good time to buy that condo. I would iterate the condo and the real estate investment right now, just because if you always, you invested and you saved for that condo, this might be a good time to buy, because if the Feds do go through that interest rate hike, for sure, that this is the best time to get your mortgage. Yeah, because the interest rate hike, the effect overall on the market might pull the money out. You don't know if it's going to affect your market, cause the stock prices to go down. Sure, you can try to hedge by buying the bank stock, but you don't know what's the effects are going to be. The effects on interest rate that causes more people to put money in the banks, is that going to drive the profit higher, the stock price higher, or is the overall market dip just going to cause everyone to sell so hard that it's just going to, the prices just end up negative? So at this point, I think, as of today, I think it's safer just to hold on to cash.
Yeah. Okay. Well, thanks for that recommendation. All right, so that's it for today's episode. If you would like to view more episodes, you can catch it at our website, www.conqueringpath.com. That's CONGKERINGPATH. You can also make comments on the YouTube page, and you can even connect with us on Facebook and Twitter. So that's pretty much it. All right, thanks a lot, guys. Goodbye.
Yeah, thanks for see you.